Welcome back to Cheddar, everyone.
Peloton officially filed to go public last night and gave us a first look at its financials. The connected bike and workout company saying it brought in, get this, $915 million in revenue over the 12 months ending in June, but that losses, they clocked in at nearly $250 million. That's 5 times bigger than the losses from the previous year. Joining us now, good friend of the show, Joshua Franklin, M&A, IPO, and corporate finance correspondent, at Reuters, joining us here today. Josh, always a pleasure to speak with you. All right, let's dive right in. What's your initial reaction after seeing these numbers from Peloton?
I think Peloton's a really interesting case. I mean, this has been a year, obviously, of a lot of high-profile IPOs already, and Peloton kind of gets a little bit of the good stuff that people have liked about IPOs so far this year, and also a little bit of the stuff that people aren't so wild about it. Mm-hmm. You know, we've seen like subscription-based companies like Zoom and other companies like that, Slack as well, have gone public to a lot of fanfare and kind of been pretty well accepted into the public markets. And Peloton is partly anyway a subscription-based model. You buy the bike and then you pay to sign up to a lot of the classes. It also is disrupting a space that has been quite entrenched for a number of years, the gym and workout space. Mm-hmm. So that's kind of some of the good stuff that people will like about it, I think, and also the fact that it's growing a lot, like to your point about the revenue that's growing. Things like the widening losses, losses coming in, almost $200 million last year, and kind of really growing at quite a fast clip is obviously a concern for investors, and they don't specify in their IPO filing how they're going to reach profitability. And we've seen with Uber and Lyft that's something that investors really are quite focused on these days. Yeah. And then also there's the fact that the company's going public with a dual class share structure, giving founders control. And this, again, with Uber and Lyft and Pinterest and other companies, has been kind of a staple of a lot of the tech IPOs we've seen this year, but a lot of investors still don't like it. They really do feel like it undermines, shareholder democracy, shareholder corporate governance.
Snap, a company that really...
Snap was kind of the real, the kind of emblematic one a couple of years ago that showed that. So it's going to be interesting to see how the market kind of shifts through these kind of positives and negatives and where it ends up coming out at.
This year we've seen new categories become publicly investable for the first time, like ride sharing, plant-based meats, and now Peloton, kind of unique in terms of the space that it caters to. Do you think investors are maybe more patient for loss-making companies when it's a totally new space to invest in? Or is there even more concern because there isn't a track record of other companies who have then gone on to become profitable in the same space?
Yeah, I think it's a really good point. I think it really does depend. It does depend a lot on how well the company sells the market that it's going into, that it's kind of leading a charge into, how much it can get investor buy-in from that. I think the problem with Uber and Lyft that we've seen is people believe that there's disruption coming in the auto space, but just the question is, how can you make money from it? Beyond meat, I think it's still such a nascent industry, but people believe that there is definitely money to be made in non-meat food. So I think that's something that Peloton's going to have to navigate with it. It's interesting because Peloton yesterday in its IPO filing, it pitched itself as a lot of different companies. It was a technology company, as a fitness company, as a media company. And I think the interesting thing is going to be, to what extent people really do see it as a new class of its own, or if you're a fitness investor or an investor who kind of got bought into Fitbit a few years ago and kind of got burned by that investment, do you think, I'm a little bit wary of the space kind of going up against a product that really could kind of cool off after a while?
In that case, it could be even worse, and they experience a ton of short activity that comes into the markets. Looking at Fitbit as an example.
For sure.
Particularly, we were talking about this a little bit earlier in the day too, and we were able to list out all of the different workout fads that there have been over the years, whether it was Zumba, whether it was Billy Blanks and Tybo and Double Time, or whether it was prancercising, or all of them. Fads, not fixtures. How can Peloton prove it's a fixture? And does it come down to the content and this narrative that they're trying to drive around them being the Netflix of fitness?
Yeah, I think that the key thing, I think Peloton is aware of this, and they've talked publicly about it before. I think the key thing for them is, at the end of the day, the people who use their products need to get results from it. They need to feel like a reason to come back. I think that was one of the problems with Fitbit, is people thought it was a great idea, it's going to measure how many steps I do, it's going to keep me honest, all this kind of stuff. But at the end of the day, people found, actually, I don't really use it that much, and it really isn't bringing that much benefit to my life. I think that's the thing that Peloton needs to keep people feeling like I'm using this product, I'm feeling healthier, and it's keeping me coming back, it's keeping me engaged. And I think that's going to be the thing that's going to give them staying power.
What is it going to take for those margins, though, to become profitable, given that the bikes themselves are already quite expensive, only for the wealthy class at this point? Is it going to be different tiers of subscriptions? Is it going to come from the subscriptions or from hardware? Where is those margins going to come from?
Yeah, I don't have any inside knowledge there, but I think that they've talked about selling more products as well. And I think,
at different price points, maybe, to
at
cater to
at different price points.
demographics.
And also, I think what's going to be interesting for them is, to what extent, the bike and the treadmill kind of becomes a bit of a Trojan horse to get into people's houses and then to sell them more products. It's a little bit, they like to play up comparisons with Apple, and some people think that's a bit of a stretch, but if you're looking at that, you see Apple sells you the phone, and then through that, they then just sell you lots of auxiliary services, whether or not it's, iCloud, iTunes, iMusic, Apple Music, whatever.
Right.
And, if you can do that with Peloton, you're not just exercising, now we're doing, whatever, sleep sounds or yoga lessons and all that kind of stuff.
Peloton ecosystem.
Yeah, no, exactly. And I think that's going to be a way, I think, for them to, because at the moment, most of their revenue still does come from selling the bike itself.
Yeah.
So I think going forward, it's not plausible that maybe they'll pitch themselves as saying, longer term, as we get more and more of these products in people's homes, we'll sell them more stuff, and you'll see more of an even split with subscription versus hardware.
I mean, it's a 2 times the price stretch on trying to drive that home that, hey, we're like Apple in the sense that we're just trying to get into your home. I mean, 2 times the price of the highest selling iPhone in that case.
Yeah.
And that goes with you anywhere. You can't take that bike anywhere. So there's that. But continuing to look at where you might see some more either competition pop up. I mean, you've got alternatives. I think we talked about Mirror in the past, some of these other new startups that are realizing that people are moving away from going to a physical gym location. If they are, how do we approach them? Mirror trying to create some type of workout in your home type of feature, but Peloton can similarly do the same to a certain extent. I mean, it doesn't have the same mirror function, but perhaps that's an area that they want to get into later on. All this to say, what does the growth look like from here? What are the future products that they could put out there, services?
Well, I think, if you're Peloton, you say, we are, I think they in their S1 yesterday, they put their total addressable market, I think it's something like 65 million homes, majority of which are in the United States. Yeah. And I think at the moment they have something like 1.4 million members. So obviously there's still a lot of, of kind of green space that they can capture. I think as well, just fundamentally, the gym space, the workout space, the model hasn't really been properly disrupted, since the 1980s. So I think it's a space that is definitely ripe for some disruption, especially in urban areas where a lot of people are too busy with work to really find the time to leave their home after work to go exercise.
Is there a carryover in the trends that we're seeing here in the U.S. fitness space and how people are working out carry over to some of the other regions of the world? Enough for Peloton to grow on?
I mean, I think the fact that they put their total addressable market, I think, I can't remember the exact numbers, but a lot of that was mainly focusing on the U.S. does suggest that they're kind of keeping it pretty close to home in the U.S. But I think the trends that we see that drive people to want to use a Peloton or services like that, I think it's true for European cities as well, or in Asia as well. So I think it's not a phenomenon that is just limited to the United States.
All right, great insight as always. Joshua Franklin is an M&A, IPO, and corporate finance correspondent at Reuters. Thanks again for your time.